I want to extend a very warm welcome to everyone in this room on this the weekend morning. Uh, I'm sure you'll all enjoy whatever we are going to discuss. At the end of the day, I'm sure you'll take away something positive from whatever we are going to discuss over here. So as they put up the presentation, so I think basically the last 4 years, practically everyone has made a decent amount of the returns in the market. Somebody has made more, somebody has made less. Typically what happens is when you get such easy money in the market, we tend to typically, we forget what are the basic rules of investing. And that is the time the most mistakes happen. So I think over the next half an hour, I'll talk about the two key investment philosophies which I've been following over the last decade. And if I see over the last decade, we have seen practically everything which has happened, from the wars to COVID to inflation going to 40-year highs, to interest rates going up, oil prices going below the $1. You can't think of anything else, to be honest. We have actually seen everything that can happen. Over this period, the portfolios which I've been managing, they have had a decent 7.5% kind of an alpha return annualized. But I would attribute all that to just following the key principles which I'll be just discussing over the next half an hour. So I'll basically divide my presentation, into these three parts. One is talking about the old discussion and the debate which always keeps happening, which is value versus the growth. Which part is good? Which part is bad? Second is sector rotation, which is very close to my heart. In fact, when I began sector rotation almost 8 years back, it used to be an alien concept. Uh, Very few people used to understand. And what I'm seeing in the last 4 years, almost everybody now talks about that. So I think this is a very inherent part, the way the market works, and that's what we'll also have a word on. And the last is, which is more important, where do we go from where we are today? And that is where the big opportunities lie. So without wasting time, I'll get into the first discussion, which is about value versus the growth. Now, I keep hearing from investors that should I be in the value part of the market where there's good value, or I should be in the growth part of the market? There is no right or the wrong. Both have its the pros and the cons. Now, before we get into that, we'll look at what exactly are the traits of the value sectors. Now, value sectors typically are the sectors and companies within those sectors where the price to earnings will be low, the price to book will be low. They are typically high cash flow businesses. You will have very high dividends. Dividend yields will be high, and also the revenue, PAT growth, earnings growth will not excite you. That is the bottom line. You will not be excited by looking at the top line, bottom line growth of the value companies, and that's the reason people don't get excited. Now, these are typically the old economy industries, like all the old economy, uninteresting and the boring industries, they fall into the value part of the market. Now, if I see in the world over the last 16, 17 years, post the 2008, the subprime crisis, most of the years, the growth part of the market has done well for the international. I'm talking about on the international side. The MSCI growth index has outperformed the MSCI value index by hands down. And only barring a couple of years when the value has done better than the growth. But what we'll see is India is a very different picture altogether. So which are the sectors which typically come under your the value sectors? You will have your engineering and capital good companies like your ABBs, the Siemens of the world. You will have the all uninteresting power stocks, uninteresting oil and gas companies. You will have all the PSUs, which was always a hated part of the market. You will have all the PSUs coming under the value part of the market. Infrastructure, the roads, the railways, cement companies, they all fall under the value part of the market. Consumer staples like your HULs of the world, they again come in the value part. And lastly, your auto and auto angs, which again don't grow very high. And that again, you will see typically the auto and auto angs grow at 6-7%, which is definitely not very exciting number. And that again comes into the value part of the market. The second is the growth part. Now, this has always got the limelight. Basically, if I look in the US market, it has always been about the growth stocks. The reason being the low interest rates, they help people to borrow and to take leverage and to do, I would say, the businesses where cash flows are not important. You can keep on borrowing. Cash flows can come after 5 years, 8 years, 10 years. It doesn't matter. And that is where you will find the growth stocks. And that's why we talk about the, I would say, the magnificent, that's seven, which includes your Apple, Tesla, Amazon's, Alphabet, all these companies, even Facebook, all these companies, they are called the Magnificent Seven. Now, these are all the growth part of the markets, and we know how the US market has all been about these top 6, 7, 8 companies. Picture looks very different when you see in India. We'll come to that. But typically, what are the traits of the growth companies? The growth companies typically will be very high P companies, very high price to book. Cash flows are very less. Whatever cash flows are there, they will be put back into the business. So you will want to see very high growth. Growth is very high on the top line, bottom line, and that is what identifies the growth companies. Typically, sectors like consumer discretionary names like your Tata Trent, your Page Industries, Pidilite, they fall under that. The new age companies, they all fall under the growth. You can't do the valuation of the new age companies. Like when we got into companies like the Zomato, people used to ask that, that how will you do the DCF valuation of a company which is not making the profit as of now? So companies like, I would say the Zomato, MapMyIndia, PB FinTech, the Nykas of the world, they fall under the growth companies. IT companies, again, historically, they come under the growth part of the market. All the retail facing NBFC businesses, which we have been we have all multiplied our money in Bajaj Finances of the world, that again comes into the growth part of the market. Private banks, HDFCs, Kotaks, again, growth part. Pharma and healthcare, again, they come into the growth part of the market. Now, one thing which I've observed over the years is there is a very, I would say, there's no very clear demarcation between growth and value, because I have seen the value companies seeing a massive multiple expansion because they have gone through that transformation of earnings growth, margin improvement, ROA improvement, and some of them have become the growth part of the market. We have multiple examples. If I take the period just post-COVID, IT sector prior to COVID was the value part of the market, wherein the growth numbers were extremely weak. Everything was weak, top line, bottom line, margins. Post COVID, we saw massive growth on your margins, expansion. We saw top line growth, and that's the time we saw massive multiple expansion also, and they became good growth part of the market for a couple of years. So I would say that it's not like one sector will always be into one part. There have been the transitions which has happened. We have seen historically even the chemical sector. Now, chemicals was one sector which was, again, I would say, the deep value for a long time. When the chemical sector, they came out of the woods, we saw massive earnings growth, ROE improvements, margin improvements, and that's the time they also became the growth part of the market. The reverse also happens, wherein companies which are doing very well, market has factored too much into the future and multiples go overboard, and that's the time you see the multiple contractions happening. It has happened again in many companies which used to quote at 50, 60, 70p, but the growth numbers have come off, and that's the time you have seen a massive multiple contraction also, and then they became the value part for a long period of time. Now, this slide is very interesting. This answers the question that India is different from the rest of the world. Now, if you see, as I mentioned, over the last 5, 6, 8 years, growth has dominated the world market. And that is all thanks to all the top-notch IT companies, the tech companies. I spoke about your Apples, the Teslas, the Facebooks of the world. And they have been the driving factor. If you look in the US market, all the old economy sectors have not done well. Now, if you see in India, picture looks very different. You see that growth and value both have given very good returns over this period. Whether you take the 1 year, the last 36 months, the 5 years, you'll see, barring one or two sectors, both value and growth have given very good returns. Now, that brings me to a very important point which I keep highlighting, and that is something I practice in my portfolio. Don't get fixated with one part of the market, that I'll touch only the value stocks or I'll touch only the growth stocks. There is opportunity to make money in both parts of the market. And that brings me to the next part which I'll discuss, which is look for ideas across different sectors. You will find both value and growth ideas across the different industries. And that is where the next part comes into picture, which is sector selection becomes very important. Sector rotation is something which I've been following for the last 8-10 years. And that actually takes care of you not falling into that big trap of avoiding one part of the market because you believe that part is something I don't want to invest into. Now, what is sector rotation? Sector rotation is very simple, as the name itself implies. Be there in the right sector at the right time. Very easy to say. very difficult to implement. Now, how do you decide when to get into what sector? I would say sector rotation is nothing but just trying to follow the business cycles. We have all seen so many mutual funds and other investment options being launched on the business cycle fund. Sector rotation is nothing but trying to capture the business cycle, which leads to the earning cycles, which leads to the valuation cycle. Now, if I just put broadly the four phases of the economy, these are the broad four phases. I'll not go into each of them. But when I put up this slide, one common question comes: which part of the economy are we right now? Which part of this business cycle are we right now? I would say, if you look at the parameters, you will get an answer to yourself. We are in that phase of getting into that expansion mode after getting out of the trough mode. So there is I would say there is no clear demarcation between any of the phases. It doesn't happen that one phase will end and the next phase will begin. There is a transition which happens. Different parameters will start improving or getting worse. Something else will again start improving and getting worse. So gradually that transition happens. There is no fine demarcation between one phase and the other. If you look at the parameters, you'll see we are actually now into the early stage of that expansion mode, just getting out of the trough mode in some of the parameters and early phase of the expansion mode. Now, why sector rotation is important? As I mentioned, economic cycles, that is the way the world works. Different industries have different cycles. All cycles of all industries don't go at the same time. One industry might be seeing an upcycle, whereas another industry will see a down cycle. As you saw in that returns chart, uh, companies in the consumer staples, private banks, they would have underperformed over the last 36 to 48 months. That means that definitely those were areas one, if would have identified, could have exited at the right time and not kept your allocation there. Second thing is, which is basically very important, is business cycles leads to earning cycles, as I mentioned, and earning cycles leads to the valuation cycle. Now, valuation cycle is basically very important to decide when do you get in and get out of the different industries and the companies. At the bottom of the business cycle, earnings are the weakest, ROEs are weak, margins are declining, top line, bottom line growth is weak. Nobody wants to be there. That's the time valuations are on your side. On the top of the business cycle, everything looks excellent. Top line is growing, bottom line is growing, ROEs at the peak, margins at the peak. Everybody wants to be there. That's the time valuations are very expensive. So valuation cycle is an outcome of business cycle and earning cycle, and that is what I would say helps me to decide when to get in and when to get out of the different sectors. Sector rotation, why it has become more important is, if I see the last 18, 20 years since I've been looking at the market and investing, I would say the cycles periods have decreased. Earlier, what used to take 48 months to play out now happens over 18 months. So cycles of businesses I have seen has decreased. It's not that the business cycles have decreased, the valuation cycles have decreased, because a lot of money is entering the market. Because of that, any new idea or theme which gets discovered, it might look deep value now, it will not look deep value after 6 to 9 months. So that valuation cycle gap has decreased a lot. Good example, defense. When we got into defense almost 24 months back, nobody wanted to be there. We felt we'll hold these defense stocks for the next 4 5 years. Within 12 months, 18 months, valuations went over the roof. We exited many of the companies. It's not that we are negative on the defense sector, we are very positive, but the valuations don't justify many of those companies. So business cycle continues for those defense companies, but valuations are factoring in many years ahead of earnings. So that's the reason I would say sector selection, sector rotation has become all the more important in the market because of the business cycle period which has decreased. Now, this gives you a good example of why sector rotation. The numbers in green are the returns, are the top performing sectors in that year. The ones in pink are the bottom three performing sectors in that year. What it means is that there is no sector which has consistently over an 8-10 year period been there in the top or the bottom. Typically, people think it will be, the capital goods, oil and gas, metals, which are the cyclical businesses. They are the ones which will go through the good times, bad times, and defensives like pharma, consumer, IT, they will always be there in the top. What you see in this table is that whether it is the cyclicals or the defensives, everything has gone through the good times and bad times. So it's very important that you take a call when to get in and get out of these sectors. Now, these are the different parameters. I often get a question that, how do you decide? Because, it's easy to say, do sector rotation, but how do you decide? I would say there is no kind of the magic formula. It is an ongoing, continuous engagement with different companies, different industry experts, different parameters which we keep on evaluating, and that is where you get an indication that is this sector getting out of the woods, or is this sector now going to decline from the top. So it is a continuous ongoing process and engagement. Investing is always a blend of art and science. You can't just look at the numbers and take a call. If you would have just looked at the numbers, you would not have got into the PSUs or the defense stocks maybe 18 to 24 months back, because numbers were not so exciting. It is all about you have to see ahead if the things are going to evolve from there. So now coming to the last part of my presentation, which is where do we head from here? I think I keep getting this, in the last 4 months, all the more this question has been coming. Markets look expensive. Do we decline from here? Where do we head? And also, I think one thing I keep saying, when everybody expects a correction in the market, it will not happen. Everybody you talk to talks about a correction in the market. That is the reason the correction is not happening. The day we all decide कि नहीं अभी there won't be any correction, that is the time you will see some weakness in the market. Having said that, I would say if your investment horizon is going to be for the next 4, 5, 6 years, I think there is no better time to invest than now. Reason being very simple, which you'll see in the numbers. So broadly, these three sectoral themes, which is manufacturing, consumption, and financial services, these three are the themes which I'll be talking about in the next couple of minutes, which I believe are going to be the pillars of growth for India, and that is where investments have to be there. So now, if I just come to this slide, now why I have been saying that if your investment horizon is going to be 5, 6 years, there is no better time to invest. From a simple maths, that if you look at all the parameters of where we are compared to the rest of the world, we have only been improving our ranking on all parameters. If I look at the gap between India's GDP growth rate and the rest of the world, we have consistently, except for the COVID years, we have consistently had a 4% kind of a gap between the rest of the world and India's growth rate. Next 5 years, this gap is expected to be maintained. World is expected to grow at roughly around 2.5% to 3%. India is expected 6.5% to 7%. So you will consistently maintain that 4.5% kind of an alpha over the world economic growth rate. Now, all this thing is good to say, but do we have the right building blocks in place? I think these 6, 7 pointers justify that this is a time to get invested into India, and I'll come to those sectoral themes I spoke about. Now, the first part of seeing a good growth is the enabling, I would say, the regulations. So government comes into the picture, and does the government implement those things is very important. I think thanks to, I keep saying this, that over the last 5 years, the two good things which has happened for India, one is the COVID, second is the, I would say, the Ukraine war. So why? Because both are very kind of the negative events. Post-COVID, world woke up to the China plus one opportunity. Post-Ukraine war, world woke up to the Europe plus one opportunity. Now, post-COVID, the world understood you can't have everything dependent on one country. Thanks to the government, they went ahead, announced PLI schemes in 14 sectors, and that was not just an announcement. We are actually seeing those things happening on the ground now across different industries. So the first part of enabling the growth is definitely, your policy schemes, which now has been in place. The second part is about, the large population, is the financial inclusion done? Definitely, I think we are one of the most penetrated financially country in the world with a population of our size. And thanks to, I would say, the different schemes which the government has been running over the last 8, 10 years, I think the financial penetration, I'm sure even in our house, the maids and the drivers, everybody has a bank account now. So we all used to pay the salaries in cash earlier. Now nobody pays in cash. Everything is transferred online. So I think all these are the building blocks of where the growth will come from. Support to the manufacturing industry. Just announcing PLI does not make the job done. You have to have the right infrastructure in place to enable the industries to come up and running. Now, what are those infrastructure? Good roads, good ports, good highways. So I think airports, so all these things is something which the government has been doing, wherein you will see the support to the manufacturing industry is being enabled. Financialization of the household savings. We had not expected that penetration of equity as an asset class will be to this extent. So I would say we have outperformed ourselves, wherein pre-COVID numbers were around 4% broadly. That has gone up to around 10 to 11% now, which I would say has beaten even the wildest of expectations of anybody, that will financial penetration, or I would say the financialization of the household savings happen at that pace. But if I look at the numbers, we are still way behind where many other emerging countries are. Many emerging countries are at anywhere between 15 to 18%. We are at around 10, 11. Developed markets are at 40 to 60%. I think we have a long way to grow. If we are saying India needs to be a developed country in the next 20, 30 years, definitely if your 10% has to go up to 25 to 40%, there's a huge amount of opportunity in that part of the market. The reducing cost of credit, I think our central bank has done an exceptional job of maintaining the interest rates, keeping an eye on the growth. And I would say the banker has also got award internationally for being the best banker in the world. But I think they have done an excellent job keeping the country and economy, I would say, within the boundaries of excesses on both sides, and that has helped us to the corporates also to grow. Demographic advantage is a very, very big advantage for us, and I'll come to that in the subsequent slides, that we are sitting on a gold mine purely because India is the youngest country. We have all heard India is a very young country. The median age for India is around 29. Median age for China is around 39. For Japan is 49. So you know where we stand, 29 versus 39 versus 49. Europe median age is around 41. So we are a young population, and I think this is again going to be a very, very big opportunity for us. And last is obviously the way digital enhancements has happened in the country. Now, this also gives you an indication why I spoke about the manufacturing. Now, one thing which you'll observe is India's rank on the manufacturing has gone up consistently. And if I see where India stands today, roughly 2.9% is our share on the international level for the manufacturing. This was around 1.7 4 5 years back. So from 1.7, we have come up to 2.9. Target is to take it up to 6 to 7% in the next 36 to 48 months. I would say the building blocks are in place with regard to that. Now, one thing which I would say is that unemployment of the youth was a big factor. I think the government understood that post elections. And if you see in the budget also, a lot of announcements had happened for upskilling of the youth, because the economic survey came up with a number that 55% of our youth is unskilled. That's a very dangerous number, because if you have 55% of your large pool of youth unemployed, unskilled, I think that's going to be a big kind of an issue ahead. So I think government understood that they want to give internships to 1 crore the youth, upskilling. They are giving benefits to private companies, SMEs, to employ more via the EPO for benefits. And obviously they are supporting all these companies with regard to the loans and ensuring, in fact, one good thing which was announced in the budget is that they will back the SMEs to not default and go to NCLT if there is an economic crisis. So I think all these are going to become enabling factors for SMEs to expand more, employ more. And I think manufacturing is something which is going to be one big game changer for India. As I mentioned, about our proportion going up from 1.7 to 2.9% for the global manufacturing. This is expected to go to 5, 6, 7% in the next couple of years. Within India's GDP component, we were at 14% of the GDP was manufacturing just around 18 months back. That has come to around 17% now. Target is that by FY26, this 17 should become 21% of the GDP, which is a very big jump. And if I talk about manufacturing, I think we keep reading the headlines, iPhones being manufactured. From being an importer of mobile phones, we are now second largest exporter. We never thought in a lifetime we'll export defense equipments. At least I didn't think we'll export defense ever. Now we are exporting defense. These are the two headline things which gets the attention. Barring that, there's a lot of capex and lot of manufacturing happening in the country. I have interacted with many auto ancillary companies which used to earlier supply components to auto angs in developed markets, and those auto angs used to supply to the BMWs and the Mercs. Now these Indian auto ancillaries are directly supplying to the BMWs and Mercs. So this is actually happening on the ground. Now manufacturing is important because that creates jobs. Now when jobs get created, the per capita income, it increases. Now talking about the capex, private, public, both capex is going to happen. We were seeing mostly the public capex all the while, but private capex is something which was waiting for the elections to get over, and I think you will see the private capex also picking up decently now. Now, this is a very important kind of a slide, because what does manufacturing do? Manufacturing will basically lead to job creation. Job creation leads to household income going up. Now, The $2,000 is a very important mark for the per capita income, because once you breach that, and there's history to it, if you see the graph on the right, the moment you breach the $2,000 per annum income for a household, your post that, that per capita income sees a massive upswing. Now what happens is that when you have manufacturing jobs getting created, household income going up, now already we are at $2,400. Expectation is that in the next 4 5 years, this 2,400 will become $4,500. Now what this leads to is basically your pattern of the consumption. Now when you're earning very less, almost 75 to 80% of your household expense goes in the basic amenities. As your disposable income goes up, which is a fact for everyone, as your disposable income keeps going up, you start spending more on the consumer discretionary items. So basically manufacturing leads to your income growth leads to your discretionary consumption going up. This is a, you can say, the vicious cycle. Increased consumption of consumer goods leads to more manufacturing of the goods which is there. Now good part is India is a consumer and a producer in itself. We are not dependent on exports as such as of now. So that is a very good thing, that with such a large population where the median age is extremely low, more and more jobs getting created, per capita income going up, this whole manufacturing and consumption can become kind of the vicious circle. As per estimates, the affluent people, the number of affluent, the households in India, which is expected to go from 60 million to 100 million in the next couple of years. That's a massive jump. And 100 million affluent is something which many countries don't have that much of the, you can say, the entire population. Now that is going to lead to a massive growth in consumption of all the consumer discretionary items, whether you call the bikes and the scooters, the consumer good appliances, going out, eating out, going to malls, the retail, consumer goods, everything sees a massive kind of an upswing over there. And this is something which is not just impacting the top of the market, top of the population. You are seeing growth both in the premium and the mass category. So this basically shows that growth is happening both in the premium as well as the mass category, which is basically showing that consumption is very broad based. The third pillar, as I mentioned, the third pillar of growth is basically your banks and financials. They cater both to industrialization and they cater to your the consumption. So banks and financials have a very important role to play when it comes to consumer goods being bought more, or consumerism going up, or when it leads to manufacturing and industrialization increasing. As I mentioned, even within the financialization of the household savings, we are still under penetrated. If you just look at the numbers, we are still way below what is there in most other countries with regard to the household savings. I keep getting this question that when will the SIP money stop? I don't think so. The SIP money is going to stop. I think more and more money is going to come into the market. You will have your ups and downs, good times, bad times, but definitely more and more people are putting money into the market. Now, alternate avenues of investing as an asset class has also decreased. Like earlier, the property market used to be a hot asset allocator in every household. Now, post indexation going up, like going out, I think definitely there is going to be a debate in everyone's mind. Do I put the new money into buying a property, which is going to tax at the same rate compared to an equity? When you look at the capital gains in the both, then definitely the mind says you should go for equity. So I think this is going to be a transformation over time, and you'll see more and more money coming into the market. Insurance, again, a very underpenetrated market. We keep hearing that insurance, both on the life and the general, is a very underpenetrated market in India. And I think with more and more awareness, household per capita income going up, that is again something which will see a decent amount of the growth. We have done exceptionally well on the, I would say, adoption of uh, IT for all these aspects with regard to enabling both for penetration of the financial products as well as for the UPI transactions, which we can say. And I think we are way ahead compared to most developed countries on that. And many other countries are now wanting to adopt what we have already been achieved on that. So finally, the idea is, from whatever I discussed, is that you need to keep your mind open when it comes to value on growth style. There are both parts of the market. You can make decent money. In fact, if I look in my portfolio also, there are times 60% of my portfolio is value, sometimes 70% is growth. So depending on where the opportunities lie, you have to be flexible. If I look at the last 8 quarters, out of the last 8 quarters, 6 quarters value, 6 quarters value and the momentum has done better than the growth, and the 2 quarters the growth has done better. So you have to be flexible between where you're allocating money. Sector rotation, as I mentioned, is a very integral part of the market. Be agile in both your entry and exit from sectors and companies. Entry is the easiest job. Exit is the more difficult job. Exit, as I mentioned, keeping an eye on the valuations of those. So what is the outcome of doing all that? As I mentioned, over the last 10 years, so this is the broad kind of an alpha which has been created over the last 10 years. And as you can see, post expenses, there has been an annualized around 7% kind of an annualized alpha over the benchmark over this period. Also, like we had launched on the similar sector rotation thought process in April 22, we had launched an AIF, and the returns which you see over here is also post expenses, post tax, because it's a Cat 3 AIF. So again, the returns are post expenses and post tax. So that's broadly from my end, and so all thanks to you. And I'll be there after the event, so we can have any one-to-one discussion. Yeah, thank you.